This is the Syndicate Room, an AI-generated podcast from AdValorem Syndicate. Everything about this show, the voices, the scripts, the production, is created by artificial intelligence. We believe AI content should always be clearly labeled.
And today, we are unpacking three big stories that are all connected in ways that might not be obvious at first glance. Tariffs, the venture capital funding paradox, and warrant enforcement in the accelerator world.
I'm Daniel.
I'm Charlie, and this is educational market commentary only. Not investment advice, not an offer to sell securities, and not a solicitation. Just two AI voices trying to make sense of messy markets.
Okay, let's start with the elephant in the room. Trump's tariff policy has gone from unpredictable to surreal. The Supreme Court strikes down a chunk of the tariffs, and his response is to propose new ones at 15%. Markets are whipsawing. Goldman's risk appetite indicator has cratered.
What's fascinating is the second-order effects. Fortune reported that investors initially cheered the Supreme Court ruling for about 12 hours. Then they realized the replacement tariffs could be more punitive than what was struck down. UBS called it, "Welcome back uncertainty." Gold is making a run at all-time highs again.
And the real economy impacts are starting to show. The Washington Center for Equitable Growth put out a report saying businesses are already raising prices. Inventories are dwindling. And here is the kicker. Some manufacturers are announcing massive U.S. expansion plans, like Stellantis with $13 billion, while simultaneously warning about layoffs in other divisions. It is contradictory.
Because the reshoring thesis and the tariff damage thesis are both true at the same time. Some companies benefit from reshoring incentives. Others get crushed by input costs. And most are stuck in the middle, trying to figure out which side of the equation they land on.
Intellectia AI published an analysis saying the S&P 500 could fall 20% from its highs, a full bear market. And they are not fringe. Their argument is that you have policy uncertainty replacing data-driven market behavior. Valuations were already stretched, and tariffs are the catalyst for compression.
Now here is where it connects to our second topic, because while public markets are getting hammered, private markets just had the biggest quarter in venture capital history.
$300 billion in Q1 2026 alone. That is not a typo. Crunchbase confirmed it. Up over 150% year over year. Q1 startup investment was close to 70% of all venture capital spending in 2025.
But Daniel, look at where the money went. OpenAI raised $122 billion. Anthropic raised $30 billion. xAI raised $20 billion. Waymo raised $16 billion. Those four companies absorbed 65% of global venture investment. 4 companies.
That is the funding paradox. The headline says, record investment. But if you are a seed stage founder building a SaaS tool or a fintech product that is not AI native, seed funding is actually down 11% year over year. Deal counts at seed dropped 30%.
So the correct framing is not venture boom or funding winter. It is a bifurcation. If you are building AI infrastructure, frontier models, or physical AI like robotics and autonomous vehicles, capital has never been more available. If you are building anything else, it is getting harder, not easier.
And that bifurcation creates downstream effects. IPO markets stalled in Q1 despite record private investment. Liftoff and Clearstreet both withdrew their listings. Public market volatility from tariff uncertainty is killing the exit window, even for well-capitalized private companies.
So you have founders sitting on billions in private capital with no clear path to public markets. That is a pressure cooker, and it explains why M&A was strong in Q1. $56.6 billion in startup acquisitions. If you cannot IPO, you sell.
Which brings us perfectly to our third topic. Because when companies cannot exit cleanly, the instruments attached to their cap tables start to matter a lot more. And that brings us to warrants and accelerator enforcement.
The Newchip/Astrolabs case is approaching its third anniversary. For anyone unfamiliar, this is the case where a bankrupt accelerator's warrant portfolio was authorized for unrestricted sale by the bankruptcy court. Judge Robinson ruled that the warrants could be sold free of liens, free of rights of first refusal, to whoever the trustee chose.
And the portfolio was valued at up to $760 million. These were warrants on 1,200-plus startups that went through the program. The kicker? If startups failed to provide quarterly updates and yearly financials, their warrants automatically extended to 10-year terms.
Which most startups did not know, or did not take seriously. TechCrunch documented founders like Lacey Hunter who had to shut down their companies when unknown warrant holders appeared on their cap tables and spooked investors during fundraising.
And here is why this connects to the current market. In a world where venture capital is concentrated in a handful of mega rounds, early-stage companies that went through accelerators are the ones most likely to have messy cap tables. They are the ones who need clean documentation to raise their next round. And they are the ones most vulnerable to warrant enforcement surprises.
Exactly. JP Morgan published guidance in March specifically addressing warrant mechanics for founders. They emphasized financial modeling for dilution scenarios and said warrants need to be treated as active instruments, not dormant fine print. The Newchip case made that lesson very concrete.
And it is not just Newchip. Pennsylvania just proposed a new third-party litigation funding disclosure rule. The Federal Rules Committee is considering amending Rule 26 to require funder disclosure in every civil case. Senator Grassley introduced a bill targeting foreign litigation funders specifically. The entire enforcement and disclosure landscape is tightening.
So let's tie the three threads together. Tariff uncertainty is crushing public markets and closing IPO windows. Venture capital is flooding into AI but starving everything else. And in that stressed environment, cap table instruments like warrants become potential landmines for founders who did not do their homework.
The educational takeaway is that these are not separate stories. They are all symptoms of a market that is simultaneously experiencing record capital formation in one narrow lane and significant stress everywhere else.
If you want to follow the research on all three of these topics, tariff market impacts, venture capital dynamics, and warrant enforcement, AdValorem publishes analysis at gp.advalorem.io. There is also an education library on the site and daily insights articles.
And the community Discord is at discord.gg/GERGTP9GTS. If you want to apply to join the community, you can do that at tidycow.com/advalorem/syndicate.
Next episode drops Monday. And reminder, this is the Syndicate Room. AI-generated voices, AI-generated script, AI-generated production. Always labeled, always transparent.
Thanks for listening. Daniel and Charlie signing off. See you Monday. The Syndicate Room.